Good afternoon, everyone, and thanks for joining us. I'd like to welcome you to this week's Monday Minute live chat hosted by the Canadian Leadership Congress. And today we're addressing the new year, what lies ahead for asset owners in 2022 and beyond. And to talk to me about this, I'd like to welcome back Johanna Kyrklund, Chief Investment Officer at Schroders. Welcome and Happy New Year.
Yes, Happy New Year. Nice to see you again, Caroline.
Yeah, so let's start with some numbers. Okay, we're looking ahead. Well, we're actually in 2022, looking forward. I'd like to talk a bit about data. Is there one piece of data or number that you'll be watching the most closely this year as it kind of unfolds?
Well, I think, for the last decade, in some sense, we've been in a bull market very much driven by low treasury yields, and that's underpinned the valuation of all asset classes. And I think the biggest challenge we face is potentially if the yield curve gets unhinged. And the biggest driver of that for me would be if wages get out of control. So that's probably the thing I'm looking at most closely, is what wage trends are, because looking at commodity prices, supply bottlenecks, the assumption is that gradually the inflation associated with those trends will dissipate a little bit. But if wages really pick up or continue to rise and we get into some kind of wage price spiral, that would be a much more medium-term challenge and would really raise questions about what the terminal rate for the Fed is. So that probably be it. If you maybe pick one piece of data, it'd probably be wages.
Wages, okay. So what kinds of conversations were you having with asset owners at the end of 2021? And do you see them carrying over into 2022, or are there new questions you're getting?
I think inflation was the big theme for all of last year, although interestingly, it didn't actually impact asset prices. Obviously, we've just started the year with a sell-off in the bond market. So I think inflation continues to be a topic. And the question is, will it actually drive asset prices more meaningfully this year? And the challenge also posed by inflation, obviously, is the need also to generate returns in excess of inflation. So definitely one that I hear a lot about. And then the other one, which is a lot newer, because of course, over the last 25 years, I've always had periods where clients are worried about inflation. But maybe a newer trend is the focus on net zero commitments. That's a big thing here in Europe. We have a lot of asset owners looking to make net zero commitments in terms of their carbon emissions and really trying to think through how they achieve those targets while still generating the returns that are required by their clients.
Okay, well, let's look at that a little bit. We're still hearing a lot about ESG. It's a huge issue for asset owners and a big focus. In your view, what's the biggest challenge for them right now when it comes maybe to approaching ESG or just building sustainable portfolios?
Well, I think, everyone to varying degrees has some kind of target. If you've made a net zero commitment, obviously you have a harder target, a more public target, but even clients who haven't gone down that path are thinking about how they can reduce the carbon footprint of their portfolios. And really the challenge of decarbonisation is that, on the one hand, if you decarbonize quickly, for example, by excluding major sectors, you might reduce the carbon footprint of your portfolio. But on the other hand, you might be undermining the integrity of that portfolio. So it's that trade-off between the speed at which you decarbonize and the impact it has on the ability to generate return. So we always say, net zero is a target, but decarbonisation is a path, and it's not necessarily a linear path. It is somewhat dependent also on the investments which are available to you. But I think that's the key trade-off between reducing your carbon footprint, but doing so in a way that doesn't fundamentally undermine the integrity of the investment portfolio.
Yeah, and I want to look a little bit more about the integrity of that sort of portfolio. Is there a role for governance to play in this? Because obviously there are a lot of decisions that need to be made, a lot of risks that need to be balanced. Can you talk to me about the role of governance?
Well, it's hard to generalize. I guess at Schroders, we have made a net zero commitment. So we ourselves are having to think about this for our own portfolios, because actually the main source of carbon emissions for us really comes from the investments that we make on behalf of our clients. We can stop flying, but that's really not going to have much of an impact compared to the impact of our investments. And in that context, we have made that public commitment and we have set very clear targets. So we're committed to net zero by 2040. And we've also come up with temperature alignment targets. So right now our investments are consistent with a temperature of just under 3%, but we're targeting 1.5%. So we've come up with some quite specific goals to try and measure our progress, and then really try to think about how we achieve those targets. For us, the answer isn't exclusion. We're much more focused on engagement with companies and also looking to try and identify opportunities to generate return, to actually make money from decarbonisation. So it's a very big topic, but those are some of the things that we've been looking at.
Well, and I see a Canadian angle in that as well, right? Because when you're talking about engagement and you're talking about different ways to measure progress on the ESG front, and you look at Canada, we have a significant resource economy here. I know plan sponsors in Canada are trying to balance that out in their portfolio. How do you see, large plans or pension plans that have these resource holdings? How do you recommend they kind of assess those?
Well, we have to assess them from a number of angles. I mean, obviously, there's the climate consequences, but we also need to think about the social impacts and the extent to which these companies are also providing employment. So we actually have a proprietary tool that allows us to basically calculate the full impact to society of any company's activities, taking in the environmental and the social. So I think that's step one, is that actually you need to think about this. There's no shortcut here. The analysis has to be extensive, and you really need to think about it across the piece. So we try and literally capture the negative, essentially put dollar value on those externalities, be it negative or positive. So that's the first thing, assessing the full impact. I think then we also believe that, this is why we don't necessarily believe in divestment, is it's also important to work with companies that might be, involved in fossil fuels, to help them to move to a cleaner future, right? So they're part of the conversation as well, and in that way we can have a positive impact to society while still investing in them. So for us, it's about engagement. It's about working with the companies we invest in the oil sector to identify targets for them as well.
Yeah, our asset owner is asking you about performance, because surely that's a key point, especially for pension plans with big liabilities and big pension payouts. You need to meet those goals. Do we have to sacrifice performance here?
So there's a number of things to think about. First of all, if we think about ESG more broadly, the G, the governance, has been around for over 20 years, something we always did as part of assessing companies. But I remember, in the late 90s, early 2000s, efforts were really made to increase the focus on governance. And I don't think you can back test governance to say that taking into account delivers alpha. But I think it is an important assessment when you're looking at a company in terms of its sustainability returns over the long term. So typically companies, so that's the first point I'd make, is that I think generally taking the risk factors that should be taken into account, and they do help you to better understand the risks that the company is exposed to. You can't back test it, but I think we can agree that over the last 20 years, a greater focus on governance has not been detrimental to returns. And I think the same could be said about environmental risks or social risks. The second thing I'd say is that we are starting to see some evidence that certain factors are becoming more important. So particularly since the Paris Agreement, we've seen an increase in carbon intensity as a factor. And what I mean by that is we were able to calculate the carbon intensity of all the stocks we own. And we're able to see that the sort of Sharpe ratio associated with that carbon factor, that carbon intensity factor, has jumped since the Paris Agreement. So I think it's true that as companies move to regulate in this, governments regulate in this direction, and companies are responding, essentially that negative externality created by carbon is being internalized into the market. So regulation is moving in this direction. It is affecting the environment within which companies. So there's certain factors where we're starting to already see an improvement in their explanatory power. The final point I'd make, though, is we need to be careful. And this is why it comes back to the point I made earlier, that as we go on this decarbonisation path, we also need to think about ensuring the integrity of the investment portfolio. If you try and decarbonise too quickly, the risk is that too much money is chasing too few opportunities, and you could end up with an ESG bubble. So, we need to be careful. This is why I think that you need to think about things, it's a multifaceted problem. And you also need to think about the investment opportunities that are out there. and you want to ensure that you're still buying companies at decent valuations. So sorry, again, this is a very big topic, but those are just 3 points I've made.
It is, and I want to, are we getting close to, I need to ask, are we getting close to an ESG bubble, or what are your thoughts on that?
No, I don't think we are. I think there's a bigger issue at the moment beyond ESG of any company, growth company. The challenge we face is what happens to yields. And that's true of companies that are renewable companies, and it might be about certain tech companies. Do you see what I mean? Any company that is very growth oriented, where a lot of its cash flows are distant into the future, is exposed to shifts in the discount rate. But I wouldn't single out ESG as a bubble right now, because I think ultimately regulation is moving in that direction.
All right. So what's keeping you up at night right now?
I think the main thing is ultimately from the starting valuations we have today, it doesn't look like prospective returns are looking very good at this point in time. So that's probably my biggest concern over the medium term, is how do we generate the return that our clients need, particularly if inflation picks up. So I think it's that return puzzle that concerns me the most. And, in some sense, the fact that in order to achieve returns, we're having to take ever higher levels of risk. So things do feel quite extended. And that's probably the thing that I'm most worried about.
Okay. And what are you most optimistic about?
I think there's a couple of things. I think I see opportunity. While we think there's upward pressure on bond yields, and I think that, the pendulum is swinging in favor of wages, of labor, which I think ultimately is the right thing. Income inequality is unsustainable where we've got to. So we're in the middle of massive regime change, but that does deliver quite a lot of opportunities as well. So, for me, disruption is not a bad thing, because typically there's opportunities on the other side. I think the other thing also is, a potential surprise for this year is that in recent years, the US has really been the only major economy that's delivered very reliable growth, and it's made it very difficult to rotate into other parts of the world. With all the money that's been put in the system, we could see stronger growth globally, and that would be quite a big upside surprise. It would put upward pressure on bond yields, but again, would allow us to rotate the portfolio into fresh positions. So ultimately, we're in a very disrupted environment. But for me, that is quite exciting, because I think it generates a lot of opportunity.
Yeah. You mentioned surprises. Are there any other wild cards you see popping up in the year ahead? There's all kinds of pockets of disruption happening, whether it's geopolitical or regulatory or tech. What do you have your eye on right now?
As you say, there's always many risks. The geopolitical environment does have its challenges as well. And I think ultimately we're in a less cooperative environment. We've been in an era of globalization for a long time, and I think we're moving towards a more deglobalized state. I also think that the energy transition, which, is particularly marked here in Europe, but the shift away from fossil fuels is, again, it's about as fundamental as it gets, that kind of shift. And it can have unintended consequences. It could continue to put upward pressure on the oil price, because we're not getting the kind of supply that we used to get. So I think commodities are actually quite an interesting asset class. They obviously had a very good year last year. But I will say, we didn't own them for about a decade because the risks were very deflationary. We started to own them last year, because of all the money in the system, et cetera, as a hedge against inflation. They've done very well. I still think they're an interesting allocation. The risks are still potentially inflationary. The deglobalized world potentially leads to more bottlenecks. Geopolitical concerns could again put upward pressure on commodity prices. So for me, I think commodity prices are still an interesting allocation. That they weren't for me for 10 years, but are still an interesting addition to the portfolio today, given some of the risks that I see.
Yeah, and obviously there's a lot of risks in the market, some potential for volatility in the next year or two. Are you approaching risk management differently, or are there any pieces of risk management that you're a little more focused on right now?
I think, one of the things I really believe in managing teams of fund managers, and within my own team over the years as well, even for me as an investor, is there's nothing more important than peer scrutiny. That's something I've always believed, because it's human nature to always want to focus on things you get right and sort of dismiss the things you get wrong. And you need that peer scrutiny. I think there's nothing more dangerous than a fund manager operating without that peer scrutiny. So that's always been my view. But I think it's even more true today because, we have some very extended trends. And typically when you have extended trends, you have fund managers perform very well, who might appear to be untouchable now, or you might have fund managers who've underperformed for many years, who just get more and more entrenched in their positions. The need for dialogue and that peer scrutiny, when you have trends which are this extended, I think is very important. I think the other element is that in the asset management industry, in the 2000s, there was a move to more multi-boutique structures. And it's certainly true that when it comes to managing investment portfolios, it's good to keep the team small. So I really believe in that. We don't have a house view at Schroders, and I say that as CIO, because I just think every single desk, the responsibility for the investment has to sit at desk level. And ultimately, we believe in that very profoundly. So the multi-boutique structure that was typical of asset managers in the 2000s was very much focused on trying to ensure that maximum level of accountability. But I think what's shifted in the last few years, again, we're in such a disrupted environment, the need to think about sustainability and what that means for returns, number one, the potential return to an inflationary regime, the shift in the geopolitical structure, all of these things actually require, I think, more collaboration between teams. So that's something that certainly we've been working a lot at Schroders on for the last few years, is actually encouraging, while before it was very much everyone doing their own thing, is actually encouraging more of that cross-asset dialogue, because we're really dealing with trends we've never seen before. So I think that's the shift that we've seen. I think that multi-boutique mentality, I don't think you can really deal with the challenges we face today with that kind of approach.
Yeah, I think that's a really good point. And over in the asset owner space, that kind of translates into silos a little bit as well, right? You get these rigid silos. And I know a lot of asset owners are working to break those down and get more cross-pollination of ideas and collaboration. As a leader, because it's challenging, how have you approached sort of breaking down those silos and getting people from different backgrounds and with different levels of expertise kind of sharing a bit more? Is that hard?
Well, the fundamental problem with fund managers is a bit like herding cats, in the sense that, you hire people because they're sort of independent minded. And, in some sense, happy to be measured basis point by basis point every day, live or die by that. And actually maybe not that keen on FaceTime. And as by FaceTime, I mean the old school definition of just showing your face in the office, right? So you're dealing with people who ultimately are quite independent minded. As I said, it's like herding cats. And for managers, typically are very sort of, they don't like sitting in meetings unnecessarily. They really want to be learning something. So they're quite sort of stingy with their time. That's something, and I say this as a fund manager myself, by the way, I'm exactly the same. Interestingly, I think because of the extent of the disruption we're seeing, I've seen a lot more interest. So, typically stock pickers are not interested in talking about macro, but because of the potential rise of inflation, suddenly they are. The potential shift in bond equity correlation is very important to them. So I think partly the disruptive times have encouraged people, the need to analyze COVID. We had to do that together because none of us had any clue when it first happened, and we relied on our data insights unit to really analyze epidemiological data that we'd never looked at before. So we're looking at stuff we're not used to looking at. So that kind of created that coalesce, that need to be talking. And interestingly, the sort of virtual working has supported it, because if the main problem used to be that people don't want to sit in meetings, the commitment level is lower when it's online like this, because actually, so, I have a Monday morning meeting. I used to have 30 people dial into it. Now I have almost 200 people dial into it, because actually it's much easier just to dial into the call than actually have to turn up to a meeting room on a Monday morning. I know that sounds silly, but it's kind of lowered the hurdle a bit. And so actually, and as people have engaged and found how useful it is. And so it, that was the spark that allowed us to continue in that vein.
I like that. And I mean, obviously, a lot of this has been enabled by technology and Zoom and Teams and all that. So I think building on that, technology has really been one of the big stories of the last 2 years. Whether it's how we communicate or the rise of some of these social media giants and some ancillary problems that have come up with that, cryptocurrency. How do you think asset owners should be thinking about technology with regard to their portfolios? Because there's so many factors that are part of this theme, aren't there?
Yes, I mean, first of all, quite fundamentally, as I said earlier, the direction of yields really matters to this sector because it is a growth-oriented sector. So if yields, I said, if the yield curve gets unhinged, which is not our central scenario, but if that was to happen, that'd be quite a major issue. That's a big picture concern. But at stock level, we still see a huge amount of disruption. I mean, people talk about things like Zoom, but also automation was something that was already in place before the pandemic, accelerated by the pandemic to some extent, because of the challenge of getting workers. So we don't think that automation is going away as a trend, for example. So we think we're still in an environment where there's a lot of technological disruption. We see that as we called it one of our inescapable truths, which is something we came up with 2 or 3 years ago, which has been accelerated by the pandemic. I think there are frothier aspects to all of this, which I think are under pressure. You know, we've seen some more challenging trends in some of the cryptocurrencies. Again, because as yields rise, that tends to sort of create a bit of a problem for more speculative activities. So that's something to bear in mind. But again, even with crypto, you know, while I wouldn't necessarily invest in the currencies as such, we do believe that the underlying technology is again a medium-term disruptor, even to our own sector. Tokenization, it facilitates tokenization, for example. And actually it's a trend that we're looking to exploit, not via the currencies, but via the stocks, you know, the fintech that benefits from some of the underlying technology. So I wouldn't dismiss the crypto trend. I think it's just about how you expose yourself to it. And probably, I could go on the subject, but for example, in the late 90s, you had the internet stocks, you know, petfood.com, whatever it was called. And obviously that bubble burst, but the internet did change the world, particularly when it was then combined with a smartphone years later. And I sort of feel the same way about this whole space, is that it might not be the individual currencies that are the investment that, you know, really monetize this breakthrough, but the underlying technology, I think it is here to stay and will create disruption for years to come.
Great. So final question, I want to pick up on something you said in your last response around yields, because clearly we've all got our eyes on the yield curve, looking at how that plays out in the next year or two. Where do you see things moving, and how are you positioning yourself, your portfolios to kind of thrive in the next next few months of uncertainty and beyond?
So I think the first thing is, you know, something I mentioned earlier, while in the last decade, our portfolio was very much equities and bonds, we actually added meaningful allocations to commodities a year ago. So already we started to displace some of that duration with commodities, reflecting the shift in the inflationary environment. Looking at our equity and bond allocations, I would say that there is still a role for bonds, though. I mean, I think the underlying tone of growth is stagflationary rather than reflationary over the next 2 years. So I'm not one of these people who write bonds off. And I think as they reprice, they get more and more interesting. So that's certainly an area that, you know, ultimately, if yields sell off a lot further, we'd be looking maybe to even add back. So I wouldn't dismiss bonds. I think you need that hedge in your portfolio. Because as I said, I don't see growth really accelerating for the next few years. On the equity side, I think it's about being more diversified. So, you know, for many years, we really favored the US in particular. We still like the US, but I think that it, you know, with extreme trends we've seen, the fact that some of the trends are quite tired, like the US, I think it pays to be a bit more diversified on the equity side. So ultimately, still invested, you know, it's still very painful to sit in cash at these levels of yields. I still think that, you know, bonds and commodities are interesting allocations in the portfolio. And on the equity side, again, being more diversified. So probably diversification for me in 2022 is the emphasis.
Yeah.
but I mean, giving up on bonds, I'm not ready to do that yet. I still think they have a role there.
Good. All right. Well, back to basics then, really diversification. Johanna, thank you very much for your time. This has been a fantastic discussion, and I'm sure everyone that watches today is going to enjoy it. That wraps this week's Monday Minute. Don't forget to send us your questions, and we'll get right back to you with our speaker's response. And we've got lots of exciting content and great interviews lined up this year that you won't want to miss. So be sure to hit the like or subscribe buttons below and visit us at leadershipcongress.ca to get our informative CLC newsletter. Thank you again, Johanna. It's a great conversation. Excellent way to start the new year. And thanks everyone for joining us, and see you next time.
Bye, Caroline.